In this video, we're going to cover diversification and ETFs. Here's the reality of the stock market. Every stock goes up and down. There's no magic investment that perpetually goes up forever. The problem that we face as investors is that we want constant growth from our portfolio, but also to not take major losses when the stocks eventually pull back. While it's not always perfect, the way that we attempt to do this is through diversification. The concept is simple. Buy multiple stocks so that when one of them's going down, there's always another going up. By owning multiple stocks, your portfolio will fluctuate based on the average performance of all of them combined. For example, if you have two stocks and one of them increases by $5, but the other drops in value by $3, your portfolio is still up by $2 overall. The more stocks you add to your portfolio, the more that they offset each other. In other words, diversification makes your portfolio less volatile and more stable. You might have less gains overall, but you'll also have smaller losses. The problem with this is choosing the right stocks and managing them effectively. There are over 2,400 stocks to choose from overall, and even managing a small number like 20 can be a challenge for a lot of people. To solve this problem, we use ETFs. Think of them as a stock bundle. An ETF, which stands for Exchange Traded Fund, tracks the average performance of multiple underlying assets. ETFs can be structured to track the value of anything, but most commonly they're used to track the performance of individual stocks. They automatically average the performance of the stocks for you. At a glance, you can quickly see the overall combined performance of everything they include. They even pay out the same dividends you'd receive if you bought each stock individually. ETFs trade the exact same way as if they were single stocks themselves. In fact, if nobody told you about them, you probably wouldn't be able to tell the difference between a stock and an ETF in your trading software. The percentage of stocks that make up an ETF aren't always equal. In most cases, certain stocks make up a larger percentage of the overall value. This is called weighting. Let's say an ETF is made up of 3 different stocks. Stock A makes up 50% of the ETF, Stock B makes up 25%, and Stock C makes up the remaining 25%. In this case, we would say the ETF is heavily weighted towards Stock A. This means that both Stock B or C would need to double the gains or losses of Stock A to have the same impact on the overall value of the ETF. In other words, weighting functions the same as if you bought more individual shares of one stock or another. Most ETFs are weighted based on market capitalization. This is calculated by multiplying the total number of outstanding shares by the share price. Market capitalization is generally used to gauge the size of a company. Weighting isn't necessarily a good thing or a bad thing, it's just a part of what the provider of the ETF thinks would be the most valuable to the investors. ETF providers are professionally managed SEC-registered investment advisors and usually have some committee that determines which stocks the ETF will include and how it's weighted. From an investor perspective, this means that when you invest in an ETF, you don't have to worry about the stocks that make it up, and can generally trust that the people managing the ETF are looking out for your best interests. This is one of the major upsides of an ETF. If certain stocks are underperforming, the ETF provider will change the weighting and remove those stocks automatically for you.